HDFC Bank Limited stands tall as one of India's premier private sector banks, known not just only for its strong market presence, but also for its unrivaled ability to adapt to grow and lead competitive financial landscape. HDFC Bank was established in the year 1994 in the city of bustling Bombay. HDFC Bank has made its mark with an expansive network of branches, ATMs, and cutting-edge digital solutions, which caters to millions of customers across the country, from everyday individuals to large corporate houses. But what really sets HDFC Bank apart is its wide range of financial products. They almost cover every corner of our financial life, whether it is personal or business loans, credit cards, saving accounts, or investment solutions. They have it all. Do you think HDFC Bank is already a giant? Wait till you hear this. The merger of HDFC Limited with HDFC Bank has birthed a true financial powerhouse. With 8,738 branches nationwide and an army of 15,182 business correspondents, this merger has solidified HDFC's bank position as an unshakable leader in India's financial ecosystem. HDFC Bank has built an empire with 5 key subsidiaries, namely HDFC Ergo, HDFC AMC, HDFC Life, HDB Financial Services, and HDFC Securities. But in order to understand the business clearly, we need to get into detail of each key subsidiary. So let's start with HDB Financial Services Limited. HDFC Bank has a commanding stake of 94.6% in this company, and it is an NBFC, which is non-deposit taking. And they offer a wide spectrum of loans and asset finance products. From lending and fee-based products to BPO services, this subsidiary covers it all, providing customers with a seamless range of financial solutions. And the second subsidiary is HDFC Life Insurance Company Limited. The bank holds 50.4% stake in HDFC Life, one of India's leading life insurance providers. Known for its long-term insurance solutions, this subsidiary ensures that both individuals and families have financial security for years to come. And coming to the third subsidiary, which is HDFC Asset Management Company Limited. The bank has 52.6% stake in this particular company, which manages the HDFC Mutual Fund, one of the largest mutual fund houses in the country. It offers a wide range of saving and investment products. It also helps individuals and institutions maximize their wealth through strategic investments. And the fourth subsidiary is HDFC Ergo. The bank holds a nearly 50.5% stake in the company, and it is the forefront of providing comprehensive general insurance products, whether it is motor, health, travel, home, personal accident, or even cyber insurance. HDFC Ergo has covered you on all fronts, both individual and corporate level. And coming to the last subsidiary, which is HDFC Securities Limited. HDFC Bank holds a 95.1% impressive stake in the company, which ranks among the leading brokerage firms across India. It offers a variety of investment vehicles from stocks and gold to real estate and debt instruments, catering to diverse needs of investors. So these are the 5 key subsidiaries in the empire of HDFC Bank. Now let's talk about the industry overview before getting into the strengths of the company. The Indian banking industry is riding a wave of growth fueled by thriving economy, along with the increasing disposable incomes, rising consumerism, and easy access to credit. In fact, the industry's cumulative profit crossed nearly 3 trillion rupees for the first time in FY24, which indicates the resilience and the ability of the Indian banking industry to grow. One of the standout achievements has been the success of Pradhan Mantri Jan Dhan Yojana, which has opened up financial services to millions of people across country. With over 51.1 crore beneficiaries and deposits touching nearly $25.13 billion as of December 15, 2023, this initiative is transforming the financial landscape and driving financial inclusion at an unprecedented scale. Looking ahead, India is all set to become the third largest domestic banking sector by 2050 by cementing its position in financial ecosystem. As of July 12, 2024, bank credit stood at an impressive 168.12 lakh crore rupees, while credit to non-food industries was recorded at 167.82 lakh crores. And not just that, deposits across all scheduled banks reached a staggering 2.11 lakh crore rupees as of July 12, 2024. And this reflects not just the trust of people in banking system, but also the optimism surrounding the India's economic future. Let's start with the strengths of the company. First strength, strong market share. The company is India's one of 3 systematically important banks and having a 15% market share in terms of bank advances. And when it comes to private bank advances, it has a market share of nearly 37%. HDFC Bank is India's second largest bank, and it is also among the top 3 banks collecting direct and indirect taxes for the government of India. And it is a market leader in almost every asset category. The second one is extensive network. HDFC Bank has a huge distribution network with almost 8,738 branches, 20,938 ATMs across 4,065 towns and cities. And you know the interesting part? Almost 52% of the bank branches in the semi-urban and rural areas. Bank is also planning to establish nearly 1,000 plus new branches in coming years, and HDFC Bank aims to increase its presence in both rural and urban areas while enhancing digital transaction capabilities. And coming to the third important strength, which is diversified product portfolio. The bank offers wide range of products and services catering to various customer segments including retail banking, corporate banking, and even wealth management. Now let's talk about the fourth strength of the company. Strategic merger. The HDFC Limited and HDFC Bank has created a combined entity that solidifies the brand position as the largest player in the banking and financial sector in India. The merger has happened on July 1st, 2023 with a net worth of over 4.14 lakh crore and a combined asset base of more than 18 lakh crore. With all these, HDFC has become the fourth largest bank in the world. And moving to the next strength of the company, which is fee income and revenue streams. This is the important aspect of the working of HDFC Bank. Fee-based income contributes significantly to the HDFC financials, driven by third-party distribution products, credit cards, and various retail banking products. In Q2 FY25, fees grew 17% year-on-year with strong growth in retail categories, but some decline in wholesale fees. Now let's focus on the risks of the company. First risk is CASA reduction. But what do you mean by CASA? CASA stands for current accounts and saving accounts. CASA deposits increased by 8.1% year-on-year, with savings account deposits at 6,081 billion rupees and current account deposits at 2,754 billion rupees. Despite this increase, CASA ratio declined to 35.3%, down from 37.6% the previous year, indicating that the share of low-cost deposits has decreased related to total deposits. With CASA deposits declining, now HDFC Bank has to rely on time deposits. Since time deposits comes with higher interest, it will impact the NIMs of the company. NIM stands for net interest margin. Now let's focus on the second risk of the company, which is asset quality. HDFC Bank's asset quality has slightly deteriorated, with gross NPS rising to 1.36% of gross loans by the end of September 2024 compared to 1.3% in the preceding year. Similarly, net NPS or bad loans rose to 0.41% compared to 0.39% in the June quarter. The third risk of the company is loan deposit ratio. HDFC Bank is aiming to maintain LDR in the range of 85 to 87% in the long term, because after the merger, the LDR ratio has spiked up to more than 100%. And what do you mean by LDR? LDR stands for loan deposit ratio. It is a financial metric that measures the proportion of bank's total loans to its total deposit. It indicates how much of deposits a bank is using to finance loans versus holding as a cash or other liquid assets. As per the Control report, the bank now aims to lower its LDR to mid 80% range over the next 2 to 3 years. Initially, management expected this could take nearly 4 to 5 years, but due to the positive scenario and positive developments in the Indian economy, they are expecting to reach this target by 2 to 3 years. But this progress needs to be observed very clearly. And coming to the last risk of the company, which is interest rate risk. Interest rate risk is the risk that affects the profitability of the company, especially for the banks, because it increases the interest rate, which will decrease the profitability ratios of the company, thereby declining its margins. Overall, NIMs of the company will be impacted due to the change in the interest rate. If we look at the finances of the company over the years, it tells an impressive story. Revenue has quadrupled from March 2017 to March 2024, with particularly substantial jump in FY24. And not just that, interest income also surged, especially in FY24, showing the bank's strong positioning in a rising rate environment. Net profit growth is equally compelling, showing consistent double-digit increases and reflecting effective cost management and a high-quality loan book. The bank's EPS has steadily risen, suggesting increasing value for shareholders and a strong return on equity. The FY24 numbers in particular reflect a new phase of growth, positioning the bank well for continued success in the coming years. And if we focus on the shareholding pattern as well, HDFC Bank shareholding pattern in March 2024 tells a dynamic story. With promoter stake dropping from 0% to post-merger, control has shifted to institutional investors and the public. FIS now hold a commanding 47.83%, while DIIs have also increased their stake to 33.33%, underscoring robust institutional support. Interestingly, public shareholding has also risen to 18.64%, with a surge in retail interest as the number of shareholders doubled nearly in a year. Now it is time for us to focus on the growth triggers of the company. The first growth trigger, booming real estate sector. The banking, financial services and insurance sector plays a crucial role in driving the growth of real estate sector. It facilitates essential financing for home buyers through mortgage products and offers capital to developers through construction finance and lease rental discounting. India is today in an unprecedented urbanization drive, fueled by rising incomes and aspiration cutting across metros and beyond. The real estate sector is expected to reach a market size of worth $1 trillion by 2030, a significant increase from $200 billion in 2021, contributing 13% to the country's GDP by 2025. And the second growth trigger is continuous support by the government. Government initiatives and policies are supporting the Indian banking industry. There are several policies, and out of which few are promising the growth of the Indian banking industry. The Pradhan Mantri Jan Dhan Yojana scheme aims to ensure comprehensive financial inclusion of all households in the country by providing universal access to banking facilities. Under this program, a person without any bank account can open a bank account without any minimum balance. And if they self-certify that they don't have any enough documents that required to open a bank account, they can open a small account. Currently, there are 52.8 crore beneficiaries of this program holding an amount of nearly 2.29 trillion rupees in their accounts. In addition, programs like Atal Pension Yojana, Pradhan Mantri Jeevan Jyoti Bima Yojana, Stand Up India scheme have all these initiatives have helped the particular industry to grow. And the last growth trigger is growing digital transactions. Digital payments have been significantly increased due to the collaborative initiatives from Government of India and the RBI, and with all the stakeholders' contribution. Right now, India accounts for nearly 46% of the world's digital transactions as per a few estimates. So these are a few growth triggers which will boost the banking industry in India. Now let's focus on the ESG. ESG stands for Environmental Social Governance. 3 years ago, bank has set a target of achieving the carbon neutrality on emissions from its own operations by FY32. Bank is now integrating renewable energy sources into their power consumption through captive solar panels in certain offices. They have commissioned a total of 25 rooftop solar installations with a total capacity of 720 kWp. And not just that, a total of 2026 offices and branches are Indian Green Building Council certified. Now let's focus on the social section. HDFC Bank, through its CSR initiative Parivartan, has maintained healthy presence in community activities in 5 focused areas: rural development, education, skill development and livelihood enhancement, healthcare and hygiene, and financial literacy and inclusion. And you know what? There are total 10.19 crore beneficiaries from the CSR activities as of March 2024. And these initiatives are spread across 28 states and almost 8 union territories. HDFC Bank has spent nearly 945 crores on the Parivartan program. Now let's focus on the governance section. Following the merger, HDFC Bank has no designated promoter entity. Without a promoter entity, HDFC Bank shareholding is widely distributed among institutional and retail investors, including foreign portfolio investors, mutual funds, insurance companies, and individual shareholders. The absence of a promoter may strengthen the governance structure of the company because there will be no promoter-driven influence in the company. And it gives board members an extra credibility and freedom to make decisions that will impact the business in a proper way. With no single controlling entity, HDFC Bank may attract more institutional participation, and that will increase the overall business structure of the company. And coming to the conclusion, HDFC Bank stands as a market leader, consistently reporting profits and increasing its revenues. One key area for improvement is loan to deposit ratio. Reducing LDR and focusing on the CASA ratio will help the company manage its NIM properly. NIM stands for net interest margin. If NIM of the company is increasing, it will impact the profitability of the company. So HDFC has to focus on these areas, and it will lead to a strong financial foundation. While HDFC Bank has managed to maintain its lead, the banking landscape is evolving rapidly, with competitors catching up, especially on the technology front, offering low-fee account, value-added services, expanding branch networks, and creating better client experiences. Can HDFC Bank continue to be the darling for the customers and investors in the long run? Let me know in the comment section. Thank you for watching the video. If you find this video helpful, please share this to your investor friends, and moreover, if you don't subscribe to the channel, please do subscribe.